Welcome to This Week in Money. I'm Jim Goddard. Today, Bob Hoye from chartsandmarkets.com runs down the major markets. Bob tells us gold is booming, but silver bugs are upset their precious metal isn't following its big brother's path to the stars. He looks at crude, the U.S. and Canadian dollars. Founder of Armstrong Economics, Martin Armstrong, tells us about his report, Can Canada Survive Intact? He looks at tariffs, the job President Trump has done so far, and the fight against corruption. Trading.com President Eric Hadik takes a look at some of the cycles that coincide with the trading of gold, the U.S. dollar, Bitcoin, and crude. Founder of TheTrendLetter.com, Martin Straith, tells us why you should get politics out of your portfolio and what was hot at the recent World Outlook Financial Conference in Vancouver. He also has a special offer for our listeners. We'll talk to Bob Hoye right after this.
Don't miss out. Stay informed. Receive the HoweStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HoweStreet.com weekly recap on our homepage at HoweStreet.com. Welcome to This Week in Money, the source for market opinions. Here is Jim Goddard.
My guest is market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. He's speaking to us from Vancouver. Welcome back to This Week in Money.
Yeah, Jim, good to be with you and good to be with our audience.
How did the stock markets do this week?
Well, it wasn't, it was okay. The S&P was recovering. It was generally okay. Like junk bonds, which is always, it gets very close to being a stock, doesn't it? Anyways, it was rising to new highs. The Canadian dollar continues to recover. Gold, of course, is up. I got it written down here as $2,969, so it's approaching on $3,000. And my gosh, that's a long ways away. I remember $400 gold being very important, but that was a long time ago. And then we took a look at at silver. It is on a lesser rise, and some of the silver bugs are getting frustrated. But once you're past the great bull market financial bubble, silver would underperform gold, so gold's the real place to be at. And then we also took a look at copper, and it's been strong this week, straight up to $4.80, and a few months ago it set kind of a nice base at the $4 level, so copper is looking pretty good. Crude oil, was a weak one this week, down to $70. And this was popped up to 79 in January, so crude oil's not doing so good. And then we kind of like to watch what the T-bills are doing, 3-month Treasury bills in the U.S., generally sideways at 4.33% yield. So I'd say it was an interesting week in the financial markets, and we don't see any disasters out there, except that gold really is getting overbought, but it has been terrific action.
What's going on with the U.S. and Canadian dollars?
Yep, the Canadian dollar was firming here a little recently. It kind of got, I think the low was close to 68. And we have had a long-term target of 68. And it's washed out with the polls against Trudeau are so bad, he's finally being seen as hopeless at government. And this is being accompanied by weakness in the Canadian dollar. But it did firm up a little bit late in the week, and I think that probably the worst is in for a while, and if we get a change in government in Ottawa, and he has stated that he's going to resign in maybe March, who knows, but perhaps the dollar is beginning to discount a change in government in Ottawa. And, that was on the Canadian side,
Bob, thank you so much for the update.
It's a pleasure, and I enjoyed doing it, Jim. And maybe we'll look forward to talking next week.
My guest has been market historian Bob Hoye. He's the chief investment strategist for chartsandmarkets.com. Coming up, Martin Armstrong next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Armstrong, founder of Armstrong Economics, available online at armstrongeconomics.com. He's speaking to us from Florida. Marty, welcome back to This Week in Money.
Well, it's always a pleasure.
Hot off the press, your 2025 Canadian report, Canada, Can It Survive Intact? It's 170 pages. Can you tell us about it and where our listeners can purchase it?
Well, it's online at our site at armstrongeconomics.com. We try to put a lot into it, all the different markets and went in detail about this 51st state stuff. These things are interesting because Canada has the same kind of problems as the United States. There are regional differences. Same thing, you go to Europe. Not everybody's the same. And, I remember Canada in the 80s when there was a big real estate boom in Toronto and they're raising interest rates to get, to stop that in Toronto, and they were putting farmers and miners in bankruptcy in the West, this is the problem with this idea of a centralized type government. And I don't think a lot of people understand, but when the Federal Reserve was first created back in 1913, they understood that. So although we had 13 branches, each one was independent. So if you look back in the old, newspapers from the 1920s, you'll see that each branch had different interest rates. So the idea was that if there was a shortage of cash, for example, on the West Coast, then the branch in your area would raise the interest rate to attract money from the other areas. And that was the idea of balancing out regional economies. And then what happened after the Great Depression, we ended up with Roosevelt, and he was really just trying to create his socialistic agenda and then took all the power away from all the branches and made it just one size fits all. And that just it doesn't work. No matter what country we look at, and even when Russia was forming, Lenin at least did understand that. Although he was going communist, he was to create it using the United States as the example. And so what he was trying to do was create a confederation that each republic retained its sovereignty. And he had even written a letter, "Do not let Stalin secede me," because he was this one-size-fits-all guy. And it's widely viewed in Russia that he poisoned Lenin and possibly his wife as well. And then he seized power, and then he did the same thing as FDR. He seized all the power from all the republics, and it was this one-size-fits-all thing. So, we saw what happened with Russia, the same thing. It's whenever you do this, it's you get different atmospheres, different economies. Even in the United States, in the Civil War, the South was agrarian, the North was manufacturer. There's differences in all the regions, and governments don't respect that anymore.
President Trump keeps talking about Canada becoming the 51st state. The establishment parties in Canada all have deep connections to Klaus Schwab and the World Economic Forum. There are also concerns about ties to the Chinese Communist Party. During Trudeau's reign, 90 out of 105 senators that are appointed, not elected, have been appointed by Prime Minister Trudeau. There are currently 10 senator openings that Trudeau still can fill. Does this provide a good argument for Canada becoming the 51st state?
Well, yeah. Well, there has been numerous arguments over the years. There was even a party called the 51st state in Quebec. They were largely Canada, was rejecting Britain mainly because its major, trading partner was the United States. So if we put the politics aside, economically, yes, it would make sense from a standpoint that you eliminate all trade barriers and things of this nature. And the biggest problem in Canada is that each province has trade restrictions against the other one, and tariffs and things of this nature. So in the United States, that would be illegal. Economically, yes, it probably would be more beneficial to Canada. From the United States standpoint, I don't really see what's the issue other than Trump is looking at it from just eliminating, the problem of trade, I guess. If from a geopolitical standpoint, if there was a war with Russia, for example, the missiles would come over the top of the globe. They wouldn't go around the belly, around, across the Atlantic. The only things that would do that would be a submarine, for example. But you wouldn't be really sending a ballistic missile from Russia around over Europe, across the Atlantic to hit the United States. You would go over the top, a much shorter distance. So that's why the U.S. has had a base there in Greenland, in Thule, since the 60s. Maybe I think even go back to the 50s, really. There's, geopolitical stuff. I understand that. Cultural-wise, we're basically kind of the same, really. Not a lot of stark differences. Whereas you get a much more stark difference in cultures as far as Europe is concerned. But that's really, if we step back and put all the political nonsense aside, that's fine. But I would be personally more inclined to take what your leftist proposal was. Forget joining. You give us California and Oregon and great, go ahead, please take them. Have a nice day. But we're just getting so polarized politically anymore. I don't really know. I think that you have movements in California right now to secede from the United States. My view is let them go. And anybody that wants to be on that side of the fence, please move there. Anybody that's conservative there that wants to get out, do a house swap. But there was a party called the 51st State Party, and I think it was in Quebec. But these things have been going on for a long time, back and forth. One province or the other joining. There were proposals from Newfoundland, Nova Scotia to separate, not join the Confederation of Canada, joining it with New England and U.S. These things have been going back and forth for a very long time.
President Trump seems to be using tariffs to stop the flow of things he doesn't want in the U.S. Migrants, drugs, especially fentanyl, low-quality steel and aluminum. What are you hearing?
Yes. What he did with Canada and Mexico as compared to China, it shows what he was doing was really the art of the deal. Make it 25%, okay, fine, then you'll negotiate. Did he want 25% tariffs? No. On China, no real negotiation, just puts in 15%. I would say you have to see what the biggest real risk, I think, is more with Europe. Europe is very protectionist. They tend to be more of a following still the line of Marxism and this idea of keeping high tariffs and blocking things to preserve, jobs. And this, look, I mean, there was an economist, David Ricardo, and he basically came out with his theory, and it's called comparative advantage. You don't grow lettuce in the Sahara Desert and putting in, where it's going to, you got to water it so much it's going to cost you $10 a head when you can buy it for 50 cents from somebody else. You should, maximize what you're good at and, bring in the cheaper, head of lettuce from somebody else, because that you're talking about the life standard of your population to begin with. So, but these people don't really, look at everything. So you have all the Democrats coming out, Trump with his tariffs, that's going to be inflationary. Okay, great. It's just politics that they're talking about. What about the sanctions you put on Russia? And that sent energy prices up dramatically for most of the world. And then they were actually locking up people to put those stickers on a gas pump with Biden pointing to the price saying, I did that. And they actually locked up people for putting them on gas things. That's, it's a very double standard on so much of this stuff. And, you have Democrats going against just everything. If Trump did it, we have to oppose it, whether it's good, bad, or indifferent. And that's just not the way things should be.
Is the push for tariffs likely to cause commodity prices to rise?
Well, in some areas, yes, but, Trump is basically trying to bring back the energy sector that Biden was basically destroying. And look, the reason we had massive stagflation in the 1970s, it was after OPEC. Energy is very important because it filters through everything. How much it costs to manufacture, whatever. That's the big problem going on in Europe. Europe is seriously in trouble. And I think they're basically going to probably go into a very deep recession, if not a depression, mainly because they went crazy on the climate change stuff. And, there's a big backlash against that now. Then they put in the sanctions against Russia, and, the U.S. blew up Nord Stream 1, and Nord Stream 2 is there, and the Germans voluntarily turned it off. I mean, German economy has actually shrunk because so many businesses have been put out of business by 3%. This is what's tearing Europe apart. I mean, it's, energy was the core of Germany. Without energy, they're not the manufacturer that they used to be. And then what you get is economic decline. I mean, it's just crazy.
Are tariff wars going to cause critical metals to be in demand, leading to possible increased prices in those commodities?
Yes, but it's not really just the tariffs. I mean, rare earth metals and stuff have largely been coming from China. What Trump is trying to do is there are such metals in Russia as well as in Ukraine. In Ukraine, he's basically saying, hey, I want to be paid back for all the money you people are wasting, and I want the metals to be, I'll take that in return. So we'll have to see. There's going to be some adjusting in here for sources back and forth, etc. But in general, we're looking at those things going a bit higher. I think you're looking also, although Trump is trying to end the war, you've got neocons in NATO that they just want World War III. And I would be very concerned about them trying deliberately to circumvent Trump and to create war in Europe.
Do you think President Trump would prefer a weaker U.S. dollar and strong stock markets?
Unfortunately, yes. But, I've heard his Secretary of Treasury talk about that, and I intend to write a letter, as they don't understand really how markets function. Back in 1985, when they were doing the G5 and stood up and said that they were going to lower the value of the dollar by 40%, that's when I wrote to Reagan. I said, listen, you do this and you're going to cause a crash within 2 years. And that became the 87 crash. Lowering the dollar to sell your widgets to somebody else cheaper, fine, but everything else in the country is also cheaper. And if you stand up and you say you're going to devalue the dollar by 40%, well, guess what? All the stocks you sold and bonds, U.S. bonds, whatever, to everybody else, they're going to sell them. So, these people don't always understand that everything is connected.
President Trump's tariffs seem to be exposing corruption and organized crime in Canada, and it looks like the swamp could be deep and spread wide. Is this a concern for the Canadian dollar?
Well, yeah, I think we're getting into this period where there's just pervasive corruption that has invaded every government around. Europe is a quagmire. We're seeing it with this U.S. aid out of the U.S. Canada, the same thing. So we're going through this period where I think people are going to begin to realize that this is very serious. I mean, we've sat back, allowed governments without any real oversight, and when you do that, this is what you get. I mean, this is why, honestly, in Washington, why they hate Trump so much, because he can't be bought. All right, what are you going to say? Do this and I'll give you $5 million. You're going to laugh. All right. And the same thing with RFK. They don't like anybody from outside their feeding trough, because no matter what you want to pretend for the press, when it comes down to money and filling their pockets, Republicans and Democrats are the same.
Looks like the Vancouver and Toronto logic-defying housing bubbles could be a result of massive money laundering, with President Trump putting a focus on organized crime. Could the Vancouver and Toronto housing bubbles burst?
Well, yeah. I mean, you're going to see a retrenchment in some areas, that's for sure. But, I mean, the same thing, like you look at Miami, and a lot of the housing bubble down there has been from money coming in from the drug dealers from South America. They tend to like real estate because it's less likely to be traced back and forth. So, I mean, all these things are definitely going to come to a head between here and 2028.
With President Trump cleaning house, could the Agenda 2030, 15-minute cities, C40 cities, climate change, and Green New Scam push be coming to an end in Canada?
I think so. You're even seeing it coming to an end in Europe. They put up all these windmills and rejected even nuclear power in Germany, and coal, and just it doesn't work. It just doesn't work. And I mean, people have to understand I live in Florida. We had 2 hurricanes. Sounds nice. Electric cars, all this, the digital money. Okay, fine. Internet was down. You couldn't even use a credit card. All right. If you didn't have cash, forget it. And you didn't have a car with gas, forget it. You couldn't go anywhere, and you couldn't buy anything.
In Canada, the Bank of Canada rate recently dropped to 3%. The federal rate in the U.S. is 4.5%. To save the Canadian dollar, would interest rates need to be increased significantly?
Well, it's a little bit more than that. It's more or less the confidence in the government. And if you start raising rates a lot, it can also send off the image that the government's in trouble. So right now, it's more of the political crisis that you have with Trudeau, and and upcoming elections. How will he will Canada finally stand up and say enough is enough, or what?
Are you impressed with the job President Trump is doing out of the gate?
Yes, I think you have to understand his first term. All right, he played ball. He listened. They said, "Oh, look, you're not a politician, and you have to give confidence to everybody." So they picked his cabinet. They put in people like John Bolton, etc. Right, and every one of them was stabbing him in the back. They were there mainly to make sure he couldn't perform. They started the Russiagate nonsense to keep him distracted. It was all basically a diversion tactic. Trump understood that. This time, he picked his cabinet before he even got to Washington. That was a shot across the bow. That was basically telling the deep state, hey, I know what you're doing. You're not going to do it again. Sending in Musk and auditing they're finding people. Where's the money going? People that are supposed to be 150 years old still getting Social Security checks? Somebody's cashing them. Who? All right. The corruption is just pervasive. They found that this U.S. aid has been funding regime changes in other governments. Kennedy basically wanted to shut down the CIA when he found out they were involved in regime changes and assassinations and stuff like that. That's probably why they took him out.
Does President Trump face the same threat from the CIA? They want to shut down the CIA.
Look, this is. I've spoken to Robert Kennedy. He knows what they did to his family, and I think I also know I've been to lunch with Anna Paulina Luna, who he has now put in charge of the investigating committee on all the assassinations, JFK, RFK, and Martin Luther King. She's handling all this stuff. I know her. She's got a real fire in her belly. And let's see. If, the FBI all of a sudden, amazingly, after all these years, we just found 2,400 pages of of JFK assassination papers we didn't know we had. Right. Somebody's looking. And look, these people have been hiding stuff for such a long time. I would be very concerned, if they try to assassinate Musk or Trump again, there'd be a revolution. These people have been called out, pretty good on this stuff, and it's just getting better by the day.
Are you impressed with the job the Department of Government Efficiency headed by Elon Musk is doing?
Yes, I think what he has done in such a fast manner is remarkable. Certainly no government-led commission would ever be able to pull off that fast. What they have been uncovering in all these different places so rapidly is very inspiring.
If you were Prime Minister of Canada, what would you do to clean up the mess?
Well, honestly, I think you need some. Why Musk is doing a good job is because he's not from government. He needs somebody from the outside who's going to come in and look at this stuff. If they're part of the game, they don't rat on each other. Simple as that. This stuff's been going on since World War II. Everybody's got their hand in everybody else's pocket. It's people are tired of paying taxes and finding money just going, billions of dollars. They don't even know where it's going. You had even Rumsfeld the day before 9/11 had to admit $2.3 trillion was missing from the Pentagon budget that year. They didn't know where it was. Conveniently, the plane that hit the Pentagon hit the room where all the records were, so they couldn't do anything. Sorry about that. It's people just don't believe this stuff anymore.
Could 2025 be a year of volatility? Yes,
I would be very concerned from May on. you have these people who we call the neocons, and they have spent their entire life winning World War III against Russia. Fine, it may have started when they were communists. They don't care that they're no longer communists. They're just Russians. That's good enough. And they just want war. As simple as that. And they're over there. NATO, I've seen the internal memos, and you have to understand about a government agent. I saw the stuff from NATO. Basically, they were concerned that all this money was going to climate change. And they actually had internal memos saying, how do we remain relevant? The only way they can remain relevant is constantly saying Russia wants to invade Europe. That's it. I mean, we don't really need NATO. We put it up because of the communists back then. The communists are gone. All right. So NATO has to continue to say Russia wants to take over Europe. Oh, if Ukraine falls, Europe's next. The average Russian has no interest in invading Europe. They just want to get along, feed their family like everybody else. Wars are created between, elites. That's about it. And NATO is fighting for its life. That's it. So they have to constantly beat the war drums. Give us money. We're protecting you. If you don't give us money, they're going to conquer you and you'll be dead. And so that's the sales pitch. But any agency, no matter what it is, they will always show their teeth when cornered and fight like any animal to the death.
Where can people follow you and purchase your 2025 Canadian report, Canada, Can It Survive Intact?
You can go to Armstrongeconomics.com. It's in our store there. I think the price is $150. And we cover all the markets, the politics. From an unbiased perspective, it's set out largely by the computer forecasts.
Martin, thank you so much for being on This Week in Money.
Well, thank you for inviting me. Take care up there.
My guest has been Martin Armstrong, founder of Armstrong Economics, available online at armstrongeconomics.com. He was speaking to us from Florida. Coming up, Eric Hadik, next on This Week in Money.
Don't miss out. Stay informed. Receive the HoweStreet.com weekly recap with thought-provoking podcasts, radio, and articles delivered to your inbox. Sign up for the HoweStreet.com weekly recap on our homepage at HoweStreet.com. This Week in Money is archived online at TalkDigitalNetwork.com.
Welcome back. My guest is Eric Hadik, CEO and president of Trading.com. He's speaking to us from Central California. Welcome back to This Week in Money.
Oh, thanks for having me back, Jim.
Eric, can you tell us a bit about Inside Track, spelled with 2 I's, and how our listeners can subscribe?
Inside Track is a financial advisory service really based in technical and cyclical analysis and focused on a lot of the financial-related futures markets, but also commodities, metals, currencies, kind of a whole gamut there. And the best place for listeners to get a better idea of what we are, what we offer, and how they can subscribe is at our website, Untitled.Trading.com. And as you mentioned, it's got the extra I in the middle, so it's INSIIDE, TrackTrading.com.
Gold broke through $2,900 this week. Where do we go to from here for gold?
Well, gold just keeps climbing and keeps advancing on this multi-year bull market that I've talked about since late 2022. At the time, metals had fulfilled a very consistent 7-year cycle, and all of my work was showing that we should see at least a 3 to 4 year uptrend from there. And along the way, I've looked for some significant peaks in there, the last one being in late October of 2024. And that kind of perpetuated a sequence of highs at about 12.5-month intervals. The next one I expect in early November of this year. But in between, I think we could see some intervening highs. A lot of my work is lined up around early May as the next significant one. But after the late October one, gold had corrected down to some pretty critical support around 25.40, 25.50, held that support, maintained its weekly uptrend, a specific indicator that I use. It created some real good symmetry between corrective moves. Its drop exactly matched the previous decline. All those things were saying that gold had gone through a corrective phase and was poised to head back up to its highs over time, and that's what we've fulfilled in the last few weeks. I do think in the short term that gold's getting a bit overbought, but there hasn't been a clear reversal signal in my work, so it's just trusting and respecting the uptrend that's in place right now.
The U.S. dollar is off its January highs. Is the U.S. dollar turning bearish?
I think that the dollar is definitely showing signs of a top. When it bottomed in late September, early October of last year, I kept explaining to my readers why I thought that it could see a decent rally into January before it was likely to peak. And so it has fulfilled that, given some signs of a top, but I still need to see some more confirmation before I would say that that's a multi-month top in place. At the very least, I need to see the March dollar index futures close below 106.50 on a weekly basis. But I do think that there was certainly the fulfillment of a lot of upside objectives, some key resistance levels holding, and a myriad of weekly and monthly cycles coming together in the first half of January. So there certainly is reason to believe that the dollar is peaking. Now I just need to see some downside confirmation to convince me of that.
If the U.S. dollar's turning bearish, could this be bullish for commodities priced in U.S. dollars?
Usually most of those commodities have more influential fundamentals impacting their price than just foreign exchange rates. I do think that when you see the dollar go through more of an accelerated decline, that's the type of thing that will often translate to a bump up in a lot of the related commodity prices. On a slower, steady basis, if the dollar did confirm a top and see a progressive downtrend unfold, certainly that would add a floor under a lot of commodity prices. But it's, like I said, it's often a lesser factor in the overall pricing of commodities. I'm more interested in a lot of the inflation indicators and factors that continue to show strength in a lot of the commodities, and some longer term cycles like ones I was discussing about in the grains last year. In July, August, September, you saw soybeans and corn go through some very powerful cycle lows. And more recently, wheat has done the same. So you've got grains already on an upswing. And at the same time, back in September, you had energy markets fulfill some pretty important downside objectives and cycle lows. So you have the energy complex steadily gaining ground. And in fact, just this week, I'm looking for a secondary bottom in crude. A lot of my weekly cycle work, but also some very important indicators, technical indicators that give you a timing factor to them, are all coming into play here right between February 11th, 12th, 13th, and I think that we could see crude bottom right here and start to turn back up. You already have some positive signals in unleaded gas and heating oil, where they are showing a bit more relative strength than crude. And natural gas gave some good buy signals a couple of weeks ago. So you've got the energy complex also showing signs of strength. And I think that we could see more upside in that complex leading into March, maybe even early April.
The Dow and the S&P 500 remain close to all-time highs. What are the cycles seeing for the Dow and the S&P?
Well, one of the things that I continue to stress is the divergence between a lot of these indexes. And in many respects, it's even a little bit more than you see with a standard cyclical rotation. But you have the S&P mid-cap and the Russell 2000 that have really been leading a topping process in stock indexes starting in late November. Then they were expected to see another secondary peak in late January. And as they've been going through this topping process, the Dow, the S&P 500, the NASDAQ 100 have been holding up and could even, based on some of their trend indicators, the NASDAQ 100 could head back up to its highs. But the other indexes that I just mentioned are continuing to roll over to the downside and kind of acting, in my view, as canary in the coal mine type of situation. So I'm watching for those indexes to signal a higher magnitude breakdown, which they have not done yet. And maybe that occurs after you see something like the NASDAQ 100 retest its highs. Coming into this week, I described why some very short-term cycles were looking for a quick spike low on February 10th and then a new rally from there. And that's what we've gotten. And the last couple of days have been kind of trading in a range, but I think that the NASDAQ could rally into the end of the week and maybe carry over into next week. But at that point, I think that you could see a more concerted downturn in all the indexes.
Crude's been moving higher this week. Is crude oil in a seasonality cycle?
Well, as I mentioned, September of 2024 was really when a lot of my cycle work was telling me to look for at least a 3 to 6 month bottom in crude. There were some similar cycles and set up in the related stock indexes, and ETFs, the XLE and the XOI index. And all of those were showing me that we could see a decent rally unfold in the energy complex into January and ultimately into late March, early April. So that's what I'm watching. And as long as crude, the March contract's what I'm watching, although that'll be rolling pretty quickly. As long as that can hold above $70, I think that you've got a floor under there, and you could see another run up in the second half of February.
Bitcoin hit a new all-time high in January. How long is the Bitcoin cycle, and where is Bitcoin in the cycle?
I think the overall cycle still shows positive outlook into late 2025, but in between there, I described this 10.5 month, 43 to 46 week cycle in cryptos that was telling me to look for a final high in January. Many of the cryptos had already topped in December, so it was more of a divergent high. And Bitcoin fulfilled that, gave just a brief spike back up to its highs, while a lot of the other cryptos were setting much lower highs. And I've been looking at a kind of vulnerable period, a danger period in Bitcoin, starting right now around February 12th, 13th, and dropping into, or the period lasting into early March, when I think we could see a decent drop in cryptos. Although you've already seen 40 to 50% drops from their highs in everything from Ether and XRP to Dogecoin. And so you are seeing those signs of topping and of vulnerability after basically a lot of them topped with one of the most bullish fundamentals they could get, and that was Trump in the presidency was perceived as being very bullish for cryptos, and markets usually top on bullish news, top on good news, and bottom on bad news. So it makes a lot of sense that Bitcoin spiked to its highest high right on Inauguration Day and has been heading lower ever since. When you get that much bullish news, what is there left to spur any further gains?
Canada's bank rate is 3%, the U.S. Fed rate 4.5%. Do Canada and the U.S. have different interest rate cycles?
I would certainly imagine they do, but I don't put enough focus on Canada's interest rate cycles to really be able to comment intelligently on that. I do think that U.S. interest rate cycles are poised to enter a kind of a reactive phase from mid-February into probably June, where I expect to see bonds bottom here right around mid-February and then on balance head higher into June. And that on balance is the key. That doesn't mean that it goes straight up, doesn't mean that it starts rallying right away, but more that we see the lowest point right around February 13th, 14th, 18th, 19th, kind of that few day trading day period, and that the high of that rebound doesn't occur until June, possibly July. In between, I have to rely on a lot of other indicators to tell me what to expect and when to expect more significant up moves. But I do think that the interest rate cycle is going to be in somewhat of a reactive phase during this time.
Lithium looks to be moving sideways. Sounds like tariffs could be bullish for the price of lithium. When unforeseen events happen like tariffs, do chart cycles tend to adapt?
A lot of the cycles that I'm watching are broader cycles, and I certainly use technical indicators, price indicators to hone them. In fact, if there's one thing I keep repeating to my readers, it's that price action is the ultimate filter. It is the determining factor. I use those cycles as a backdrop. And so those cycles I don't think really change based on one fundamental here or there. It's more a case that the fundamentals usually end up validating those cycles, and the fundamentals often kick in partway through, often about a third of the way into a new cycle. So it's very common for things like that to occur within a particular cycle. And also, as I was just mentioning with Bitcoin, you can also see a final fundamental kick in at the very end of a cycle, where, again, you've got, in the case of Bitcoin, you've got people buying on every possible bullish perspective, outlook, fundamental. And so at that point, where are new buyers going to come from? Who's going to buy now that everyone else has loaded up? And that's what a lot of more novice traders don't understand. They read a certain fundamental related article and think, oh, well, this is bullish for whatever market, I should buy it. If everyone knows it, then it's too late. In fact, often that's time to start selling it, or at least getting out of it. So those cycles are often reinforced by fundamentals more than the fundamentals actually changing them.
Eric, where can listeners subscribe to Inside Track?
They can go to our website at InsideTrackTrading.com, and that's spelled with the extra I in the middle, so it's INSIIDE, TrackTrading.com.
Eric, thank you so much for being on This Week in Money.
Thanks for having me back, Jim. Always a pleasure.
My guest has been Eric Hadik, CEO and President of InsideTrackTrading.com. Coming up, Martin Straith, next on This Week in Money.
Always consult your investment professional before making any investment decision. This Week in Money is archived online at talkdigitalnetwork.com.
Welcome back. My guest is Martin Straith, founder of Trend News online at thetrendletter.com. He's speaking to us from Coquitlam, BC, which is just east of Vancouver. Welcome back to This Week in Money.
Always a pleasure, Jim. Thanks for having me.
You were speaking at the WFC conference in Vancouver, and you told investors to get politics out of their portfolio. Do you not believe things like Trump's tariffs move markets?
Oh, yeah. Well, I mean, certainly the Trump team is making headlines, pretty much every day here. There's no doubt that his actions have an effect on the markets, but at least in the short term. The tariff threats, they're certainly newsworthy, but the market, up to this point, has basically just shrugged them off. So, there's obviously a lot happening. They're cutting jobs, government jobs, regulatory rollback, foreign affairs, negotiating potential Ukraine war end. Those are pretty big if they get the results. The one thing that has really caught my eye is really how that dodgy team has been so aggressive. Jim, if they're going to come through and actually audit the Pentagon, can you just imagine how much waste they're going to find there? So I think that's going to be something to see because I think that's going to open a lot of eyes. But historically, the markets, they're always looking forward, and politics don't really tend to have much effect longer term. So, look at the last 2 years. The market, this market's been up, 24% in 2023 and 23% last year. And that was with Biden as the president. So, and I don't think many people would consider Biden a business-friendly president. But in that conference, so I showed this slide, which I thought was really interesting, and it got a lot of feedback. So this is a slide that starting in 1953, so 71 years, almost 72 years ago, I guess, if somebody invested $10,000 in the market, but they based it on politics, it's quite interesting to see what the numbers were. So if you were that investor, and let's say you only invested when the Republican was the president, so meaning that if a Democrat was president, you took the money out of the market. And when the Republican was in, the money was all in. So that money today would be worth, that $10,000 would be worth $290,000 today. Now, if you did the opposite, so if you only invested if a Democrat was the president, meaning that if a Republican was, you took the money out, that $10,000 would be worth about $690,000, which is kind of interesting, over double what the other one was. But here is the big one. If you just left the money in the market for those periods, it didn't care who was the president, didn't matter, that $10,000 today would be worth $20 million. So, when I say, take the politics out, certainly there's going to be a little short term. When Trump opens his mouth, stuff happens, but the market tends to kind of shrug it off. So, but I think that, just at the conference, talking to, we talked to a lot of people. That's the thing I love about those conferences. And the sense was, I was just blown away of how much politics affects how these people were talking about how they wanted to invest. And so right now, if you look at the chart of the S&P 500, you would see that it's in an uptrend. It's been in a nice diverging wedge pattern since about October 2023. And the key to us is, we watch the markets. Sure, we have opinions, but we let our models tell us when they see a potential trend change. Because right now the market is in an uptrend. It's been in one for quite a while. So it doesn't matter what Trump says or whatever action. You just want to watch the market. If the market moves, well, then you want to deal with that. So to us, we look at the lower rung of that uptrend channel. If the market were to break down below that, well, we're going to sit up and take notice. If it were to, so that would be around the 6,000 level. Now, if it broke down, there's a nice support level about 5,850. Now, if it broke below that, now we're really paying attention because now we really start to consider adding a hedge. But right now it hasn't done any of those. So there's no action required. If you're in the market, stay in the market, watch for those trends, make sure if they don't change. And as long as they don't change, right now the market's moving higher, the trend is higher. That's all we need to know.
And for people, when I said the WOFC, that's the World Outlook Financial Conference. Now, at the World Outlook Financial Conference, you talked about small cap stocks. What do you like about small caps?
Well, small caps, just by definition, they're smaller companies, publicly trading companies with small market capitalization. So typically under $2 billion. Now, the thing that's enticing about it is you got that growth potential, because these are companies that are typically in early stages of development. So there's significant room for expansion and market share growth. So that opportunity for higher returns compared to these larger, more established companies is quite compelling. So, if you look at the risk reward, obviously there's a much higher risk for these guys. There's less stability, certainly less market presence, but the potential for long-term gains can be significant, especially, precisely if the company is successful. Now, so the appeal to me is, you got these early stage opportunities, and you've got this exposure to, emerging industries and innovative businesses. But if you're going to invest in small cap stocks, you really have to understand that there's a very strong inverse relationship between the small caps and interest rates. One of the things I showed at the convention was, I showed a chart, and it just clearly shows that incredible inverse relationship. These companies, they do not have billions of dollars in cash laying around like Apple and Amazon, those big guys. So in the chart, what we could see is that in December, interest rates started to rise, and exactly mirroring the opposite direction, we saw the small caps decline. And now this week, we're seeing interest rates dropping, and we're seeing the small caps rally. So it's really important for your listeners that if you want to get into small caps, you have to understand that relationship with the interest rates.
You've said many times investors need to understand currencies as everything is connected. What do you see for the currency market this year?
Yeah, well, when you look at currencies, like I say, everything's connected. So if the U.S. dollar, which is the world reserve currency, well, if it's rising, then most other currencies are falling. Now, recently, we saw the U.S. dollar, it was, had a 2.5-year high. It was up almost 10% in early October to early January. That's a crazy, rise for any currency, and especially one that's the world reserve currency. But, so then you got to ask, well, why was the U.S. dollar so strong there? And again, I showed a chart here, and it's the 10-year bond for a number of countries. Well, the U.S. 10-year bond was paying 4.5%. Canada was 3.2%. Germany was 2.4%. Sweden 2.2%. Japan 1.3%. And Switzerland was only 0.43%. So you've got the U.S. bond paying much higher yields than most of these other markets. So think if you're a German or a Swiss investor, and instead of, in Germany getting 2.4%, you kind of like that 4.5% in the U.S. And think about the Swiss investor. Instead of 0.4%, he could get 4.5%. But in order to do that, they would have to then take their euros or their Swiss francs and buy U.S. dollars in order to buy those U.S. bonds. And so that creates a demand for the U.S. dollar. The other key factor is U.S. stocks were far outperforming European and Asian stocks. So let's just say you're a German investor, and say in August you wanted to get some money into the U.S. stock market because it was outperforming most of the European markets. Well, let's say you wanted to buy the S&P 500, and so you just went to the ETF, the SPY ETF. So that's just a one-to-one relationship with the S&P 500. So in August, that ETF was trading for $515. Today, the SPY is trading at $615. So that's up 19% in 6 months. But then, if we add the currency play, so since August, the euro had dropped almost 8%. Well, actually, it was over 8%. It's a little less than that now as it's been rising. But if you were that German investor and you decide to take your profit, well, you would have made 19% on the SPY trade, Plus, because the euro dropped about 8%, you get another 8% on the currency trade. So now you've got a gain of 27% in 6 months. I mean, that's a pretty sizable gain. And so you can see why these foreign investors were converting their domestic currency into the U.S. dollar in order to buy those U.S. stocks and bonds. And it's one of the reasons we're starting to see the U.S. dollar declining a bit, because some of these guys are taking some profits because, why not? So, like I say, since mid-January, the U.S. dollar has been falling. So now we've got Trump and his Treasury Secretary, Dissent. They both say they want a weaker dollar. And now the dollar has been dropping. Like I say, some of these people have been taking some profits. You've got uncertainty around the tariffs and potential trade wars. So that's kind of pushed the U.S. yields a bit lower. So we're seeing the bond prices change. So that makes them a little bit less attractive for foreign buyers. And again, we're now also seeing European and Asian stocks starting to rally lately. And then again, they're starting to close the gap on the U.S. stocks a bit. So now all of those combined, we're starting to see that the U.S. dollar's kind of dropping here. Now, in Canada, we've got a strong U.S. dollar meant the Canadian dollar was weak. So the Canadian dollar dropped, I'm sure everybody listening, knows it was down like 68 point, I think it was 3 about a week and a half ago. Like that was a 23-year low. So for Canadian families, I mean, that is bad news. So that means higher costs for imports, particularly now. We import a lot of our food from the U.S. or Mexico. And then, if anyone was traveling down to the U.S. this winter, I mean, you're paying, $1.50 for every dollar of U.S. travel costs there. But the good news for a cheap Canadian dollar is, if you're a Canadian resource company with assets in Canada, well, this is good news. So your costs are in Canadian dollars, so your labor costs and so on, yet your revenue is in U.S. dollars. So if you're a Canadian gold company, and you got Canadian assets with Canadian mines, so like a Nico or one of those, well, you're paying all your costs in Canadian dollar, and you're getting paid, $2,900 US for your gold. So, I mean, that's a fabulous combination for these companies. Now, looking ahead, I mean, of course, we're already in a terrible economic situation. Horrible government policies for the last 9 years. We should be one of the richest countries in the world, thanks to our natural resources. And unfortunately, for the last 9 years, they've been forced to pretty much leave those in the ground. So that has to change. The last week, we've seen the U.S. dollar dropping. The Canadian was finally able to push back up above just over 70 cents. But Canada needs to get its economic act in order. And otherwise, we're just going to be left in the dust here behind the U.S.
When you were last on, you talked about how you were looking for a rotation out of big tech and into things like commodities. Which commodity sectors should investors be looking at?
Yeah, we really do see that's something that, and it's interesting talking to a lot of the investors at that conference. A lot of people have made a lot of money. They bought NVIDIA a few years ago. Well, that's up anywhere, from 900 to 2,000%. Celestica, I mean, that's a Canadian cloud storage data center company. They're up 1,400% the last year or so. The Googles and those guys, they're up 300-400% the last few years. So the portfolios of those investors, the companies that they've been holding is so heavily weighted in big tech. So many of these investors are starting to look, they got to lighten their exposure. So if they're going to sell these, big tech stocks, at least some of them, and they want to diversify, well, they've got all this cash now, and they want to get away from all of it being in a big tech. Well, one of the great ways to do it is find sectors that have been, that have not done well recently, and that are starting to turn. And that's the key for us. We watch trends, so you want to look at trends that have been trending down, and now they're starting to trend up. And so commodities is definitely one of the areas we like. And, one of the things you have to know, though, when you're investing in commodities, you have to be aware of the supply-demand price cycle. And what I mean by that is when prices are rising, that increases cash flow for any companies that are in that sector. And what that does is when that happens, well, the heads of those companies go, well, this is great. Let's produce more of that. And so the companies, and it's not just the one company, every company that's in that sector starts to reinvest and start to, increase production. But over time, what happens, obviously, is then supply starts to outpace demand, prices start to decline, that decreases cash flow. So now the companies start going, well, we're losing, we're not making the profits we were. We start to look to slow down, and in some cases even shut down production. Well, then that all of a sudden, over a period of time again, demand now outpaces supply, prices start to rise, and then that cycle just goes around again. So the sectors we like, energy is definitely one of them. You look at oil, oil has tested $67 support 5 times since September. Now, and every time that is held. Now, we could see it test one more time, I'm suspecting. It's kind of hanging around this little over $70 right now. But you've got that ceasefire in the Middle East, so that certainly added, helped, take away that war premium for oil. And then you've got potentially a peace agreement coming in Ukraine. I mean, if that were to happen, now all of a sudden you've got calm in the world, hopefully. Let's hope that happens. And now you've got more easy transportation and movement of oil. So that could increase the supply. And then, of course, we've got the mantra of drill, baby, drill. Now, as I say, oil's, just hanging above $70. I could easily see it break below that, possibly test that $67 level again. But remember, when I hear people say, well, build, drill, baby, drill, oil's going to go down to $20. That's it. I mean, remember just what we talked about, that supply, demand, price cycle. Oil companies are not going to just pump up, lots and lots of oil if the prices keep dropping down. They have to make a profit out of it. Now, if you're looking at oil, just if you're looking at seasonality, right now, starting early February, that is when oil has its best seasonal period. So typically oil will rise from early February right into July. So that's something your listeners need to keep an eye on. Now, if we look at natural gas, another area we like. Now, the thing about natural gas is, and I'm sure I've talked about this on your show before, natural gas is extremely volatile with massive price swings. No, I'm just looking at a chart of it right now. So this is a chart that just dates back to April. So not even a year. Look at these, listen to these price swings. Up 81% in 2 months. Down 38% in about 2 months. Up 56% in about 4 months. Down 24% in a couple of months. Up 87% in 4 months. Down 29%. I mean, those are crazy swings. But if you look at it, near term, natural gas, so it hit its low about $1.50 in last February, not this one, last one. So that was the lowest levels in about 25 years, since 1999. Since that low 1 year ago, natural gas has been rising in a nice uptrend channel. It peaked at $4.30. So it went from $1.50 up to $4.30 in early January. Then it fell back, to $3, and now it's rallied back to about $3.70. So as I say, incredibly volatile. But, if you play it, you can play that up and down. So there's some easy ways for your listeners. You can play the U.S. natural gas fund. So the ticker is UNG, and that basically, tracks natural gas futures. So you're not going to get the exact swings like the up 87%, but you're still going to get a nice run. You could also do leverage play. So ProShares Alter Gas, that ticker is BOIL, BOIL. So that's a 2-time play on natural gas. And then for the declines, you can play the ProShares Ultra Short Gas. I'll see these ticker names. This one's COLD, so KOLD. And so that's a 2-time leverage play. Now, based on seasonality, natural gas typically doesn't run up until about another month. So you probably got another month to kind of pick your weapons that you want to use for up and down plays. But again, natural gas, very volatile, but you can make a lot of money if you play the time it right. And then we got nuclear So, the question people will ask you, well, why do you want to do nuclear? Well, stable, reliable energy. These plants run 24/7, continuous. They don't care if it's sunny out. Doesn't have to be windy. It can be dark, stormy, rainy night. These things just run 24/7. Low greenhouse gas emissions. Public sentiment's getting better. Even environmentalists. The COP28 environment conference, like over a year ago, 20 countries, Canada, U.S., France, UK, they launched that declaration to triple nuclear energy. So, figure it out. There's 440 plants in operation today. Well, if you're going to triple that, that's 1,320. If you got 65 under construction and 110 planned, that means you still need 1,145, new reactors to meet that target. Now, we know that, at those climate conferences, they always set these sky-high expectation and dream targets. But even if they only did half of that, that would still be, you would still need 570 new nuclear reactors. So that means you need a lot of uranium. Now, when we got into uranium, we first got into it in 2002 when we first published the trend letter. Uranium was trading like $11 a pound, and we hit that timing was perfect. It went from $11 to $147 in about 3 to 4 years. And those stocks did fabulously. We had gains of 800, 900,000. I think one of them was over 1,500. Then we had supply chain issues, and then we had the financial crisis. And then, in 2011, we had the Fukushima crisis. And so uranium went from 147 all the way back down to $25. And in 2020, at that 2020 World Outlook Conference, we were pounding the table to buy uranium stocks then. And then it went from $25 to $50, and then quickly up to $106. And so, we had gains there at about 800%. And at that conference last year, exactly to the day, it was $106 for uranium. And people at the conference were asking, is it too late to get into uranium? And I posted the chart saying, no, but we need to see a pullback. And so what I showed at the conference this year was exactly that. At that time last year, that was the exact high, almost to the day, at $106. Well, uranium now is trading under $70, but so he said it needs to have a pullback. It is now testing its uptrend line. So we're watching that very closely. This could be a good buying opportunity for uranium. If it breaks through the support level, then it could drop even down to like the $60 to $70 range, $60 to $50 range. So we're keeping an eye on that. We'll be letting subscribers know. But if your listeners are interested or they missed the last round of uranium, I think we're going to get close to another good buying opportunity. One more was copper. So that was the other big commodity we like. And as I say, we're expecting a rotation out of some of those big tech stocks. And again, they're not going to sell. You don't have to sell all of them, but you want to take some profit and balance out your portfolio. So if you want to diversify, I think copper is going to be another great way to go. Copper demand continues to grow. And even without, the EV, renewables, and data centers, the supply of copper has not increased. So if we get EVs, obviously with Trump in there, it's not going to be as pushed as much, but still there's people going to buy EVs. There's going to be renewables. There's going to be data centers. That is just going to add to the demand. Now, the only thing that we've been warning subscribers is, we don't know how all these tariffs are going to play out. We don't know if there's going to be some trade wars happening. If we were to get a global trade war, and especially if China's in the middle of it, that would not be good for commodities because China is such a big driver. So you need to be a bit patient, and a weaker dollar would certainly benefit commodities. But we're looking at copper now. Copper broke through its downtrend level. It just broke through a key resistance level. So we're really liking copper going forward here.
Over 6 months ago, you called for gold to hit $3,000 in 2025. It's over $2,900 now. What's your forecast for gold now?
Yeah, gold's been on a tear, hasn't it? It's up, I think, 12%, 13% already this year. So, and we're talking in 6 weeks. So yeah, I mean, our call for 3,000, it's right on track here. Now, the gold miners have not kept up to the bullion. And one of the key reasons is, we probably talked about this last time I was on, central banks, particularly those ones that are not friends of the West. So, China, Russia, Iran, etc. They've been major buyers of gold. And they don't want gold stocks. They want the bullion. And they don't want the bullion, they're not leaving it in New York or London. They want it in China or Russia or wherever they got. They want to hold on to that. So they're not interested in gold stocks. But the good news is for the stocks is that because gold prices have been rising so much and the producers are making so much more money, we talked earlier about Agnico Eagle. I mean, there's a company that's got all its costs are in Canadian dollars and their gold's going up crazy and they're getting paid in U.S. dollars for their gold. I mean, that's good news for those gold companies. So we're starting to see gold miners now are rising, especially in the last few weeks here. So they're closing the gap. So the retail investors are starting to get in. The institutional investors are starting to get back in. So right now, if your listeners have missed this last run on gold, it's technically from our targets, it's overbought here. So we should be seeing a pullback soon. So right now, last I saw it was about 29.50. So I would see, 28.75 is a kind of initial support we'd be looking for. 27.30 would be a nice level to come back to. Big key though, longer term, gold has been in kind of a 3-year consolidation phase. And in a bull market, when you get those kind of consolidations, they're often followed by upward movements lasting kind of in a similar time frame. So we should be seeing, gold run for, a good, multi-year run, I would say.
When you were on last month, you said Bitcoin fell out of its near-term uptrend channel in December and tested support at 92 grand. What do you see now for Bitcoin?
Yeah, I mean, pretty much the same story as I said last time. As you say, Bitcoin was in a nice uptrend it jumped really high, like in about November. It had a big spike higher. That was back when, pre-election stuff and Trump was pumping up Bitcoin. And then it continued in this nice uptrend. But then in December, it fell out. And since then, it's been kind of trading in this pattern. As you say, it bottomed out support at 92.5. And it's tested that level 3 times now. And on the upper level, you got 108,000. So that was the previous high. So what we've been watching now is that the lower rung of this uptrend channel is now acting as kind of a resistance level. And we're seeing that what Bitcoin's doing, if people could see this chart I'm looking at, Bitcoin is basically bouncing from 92.5. It bounces up, tests that, that rung of that channel. And it's kind of like somebody on a trampoline. Each time, that movement seems to get a little bit higher and a little bit higher. But now we're starting to see Bitcoin is not being able to jump up as high, and it's starting to kind of trend back toward that 92.5. So that's what we're really keeping an eye on. If it tests 92.5 and that level does not hold, then that's something to sit up and take notice. Because if it falls through 92.5, we could see it drop down fairly significantly, down to 80 and even down to the mid-70s. So keep an eye on that. Now, if it can break through 108, then that's positive, that's bullish, and that would put it back in that uptrend channel, and that would be, that would send it on its way looking toward 200K. But again, we let the markets tell us what they're doing. Those are the numbers we're watching. Those are the numbers that our models are paying attention to. Now, one of the things I just want to mention, because at the conference, we had a number of people telling us, and we were just talking about, the rotation out of big tech. So a lot of people saying, I've made a lot of money in NVIDIA and all these other big techs. My advisor's telling me I should start diversifying. And so many of them said, I'm thinking of buying Bitcoin. And so I just want your listeners to really be aware here. Understand the relationship here. Bitcoin and like the NASDAQ. So Bitcoin and big tech have been trading in the same pattern for the last number of years. And especially in the last few months, Bitcoin and the Nasdaq QQQ, which is the ETF, they've been just trading in tandem. So if you're buying Bitcoin, all you're doing is just reinvesting in the same trade. You're not diversifying at all. You're just simply adding to your risk. So it's really important for your listeners to understand that.
At the Vancouver World Outlook Financial Conference, you talked about decentralized finance, or DeFi. Can you tell our listeners a little bit about that?
Yeah, this is something we talked about at that conference a few years ago, and it's interesting. So I asked the people there. So the room, there was about 500 or 600 people in that room. I say, who's heard of DeFi? And I would say maybe 30, 40 hands went up. And then I asked, well, how many people have invested in DeFi? And there might have been maybe 8 or 10, something like that. And I don't know if they had even done it. So we're talking decentralized finance. So what it is basically leveraging blockchain. So, I'm sure most people have heard of the blockchain. Bitcoin is on the blockchain network. So it's decentralized. So it's instead of like one main server, like a bank or something, these are decentralized. So it's spread out all over, multiple computers, multiple areas, multiple nodes. And what it is delivering financial services without traditional intermediaries like banks. And it's, like I say, it's based on decentralized networks, similar like the Ethereum network is one of those networks. So the key features are you've got transparency, you've got easy accessibility. Anybody with a computer can go on and access some of this stuff. And it's starting to grow. So, the thing what I was talking about a few years ago, people were, look and say, well, is that some kind of dream or what? So it's programmability is easy. It eliminates middlemen, as we say, it reduces fees. So you have things like smart contracts that enable new financial products. So things like peer-to-peer lending without a bank in the middle. Think about that. I mean, think about the bank, how much they suck up of that. Think about fractionalization. I know these terms might sound a little spooky to some people, but fractionalization. So think of this. So ownership of big businesses. So let's say you've got a commercial real estate building. Well, traditionally, the only people that could buy that, let's say this building's worth $20 million. Well, the only people that could buy that would be, big institutions, big companies that have $20 million to spare. But if you were to fractionalize that and break it down into, more affordable units, what you do is now you've opened up that, millions of more investors could get involved. So let's say that warehouse is, it's valued at $20 million. Well, let's say the person who owns it or the business that owns it now says, well, why don't we try, this fractionalization? So we divide it in, say 20,000 units of $1,000 per. Well, now any investor could buy, 1 unit, 5 units, 10 units, whatever units you want, for 1,000, 5,000, 10,000 or whatever. All of a sudden, Jim, you and I could each say, well, I'm going to buy 5 units of that. I got 5,000. Why not? That's a good warehouse business. And all of a sudden, you own a piece of that. You own a piece of that business. So now you've got these small investors that are able to invest in a market that they never had access to before. And you've got the owner of that business now has millions more potential investors than he did before. So we're starting a new service. It's called DeFi Digest. It's brand new, but I'm sure most of your listeners probably go, I don't know, I don't think I'm into that. But I'll tell you, I think they will. I know that the next year's conference, when I ask how many hands, there'll be a lot more hands, and I guarantee you 2 years from now, I bet a third of that room they're very well aware of it, just like they're aware of Bitcoin. It took so many years. So DeFi Digest is going to be part of our Trend Technical Trader service. Anybody that's interested, just send us a note at info@thetrendletter.com and you get some more information. But I honestly think, Jim, anybody who missed the opportunity to get into Bitcoin or NVIDIA or any of those kind of companies before they became wildly popular, we see this as another one of these game-changing technologies.
We've talked about the global sovereign debt problem many times. Is there ever going to be a solution to it?
Yeah, that is just a mess that just keeps getting uglier. So there is $320 trillion, that's a T, trillion dollars in total global debt. And the total has doubled in the last decade, and it's up almost 14 trillion just last year. Most of this is government spending. So if you take, I asked ChatGPT, how many people in the world? So there's 8.2 billion people in the world on the planet. Well, if you take that $320 trillion and break that down per person, that equals $40,000 per person. I mean, that's insane. So, yeah, what's the solution? Well, I think the first thing we have to do is that governments have to quit spending more money than they have. And, so far we haven't seen, we don't even see debt even debated in a political election. Now, of course, we've got to see what Trump and his dodgy team do. Like I mentioned earlier, they say they are going to do a full audit on the Pentagon. And I am so very interested to see what waste comes out of that audit. I suspect ultimately we're going to have to see a new monetary system, something maybe like the Bretton Woods that came in after World War II. We've already got the BRIC countries. They're looking to have a gold-backed currency to get off the U.S. dollar. There's a thing, called the M-Bridge project, where central banks like China and Thailand and the United Arab Emirates, they've started a process where they want to build on blockchain, they want to build a central digital bank currency that would trade as independent of the U.S. dollar, and it's just for trade. If you look at just the U.S., these numbers are easy to pick. So their national debt, so their government debt is $36.5 trillion. So that works out to $107,000 per person. Their unfunded liabilities, so things like, Social Security and Medicare and so on, those are unfunded. So there's no money put aside for it. $226 trillion. So that works out to $666,000 per person. So if you add up those two, that works out to $773,000 per person in the U.S. Totally unsustainable. So now maybe this Doji team, maybe their findings will finally wake up the world, to how horribly governments have mismanaged our money and on so many wasteful programs. But something's got to give, and so hopefully, this dodgy team pulls the curtain back, and we all get to see what's happening behind it. I sure hope so, Jim, because things have to change. This is terrible.
At the World Outlook Financial Conference in Vancouver, you offered an incredible special off to the audience, 33 to 57% off your regular prices. Can you extend that to our listeners?
Oh, yeah. That actually is supposed to end tonight. So, we'll run it through maybe early next week. Your listeners can just go to our website, thetrendletter.com. So that's, all one word, thetrendletter.com. And there's the World Outlook. It's a big red banner thing there that's got the special price. So, so what you get on any of the singles, you get like $200 to $250 off. If you bundle up two of them, you get about $600 to $650 off. And if you buy all three of them, I think you save $1,050. So you save well over 50%. So we're running. We ran that for a week. So for your people, we'll run it for maybe to the middle of next week or something.
Martin, thank you so much for being on This Week in Money.
Oh, always a pleasure, Jim. Always enjoy it.
My guest has been Martin Straith, founder of Trend News online at thetrendletter.com. And that wraps up our show for this week. We'd like to thank our guests, Bob Hoye, Martin Armstrong, Eric Hadik, and Martin Straith. And thank you for listening. If you have any questions for the show or for our guests, you can send them to info@HoweStreet.com. I'm Jim Goddard. We'll be back next week with more This Week in Money.
Comments made on This Week in Money are an expression of opinion only and should not be construed in any manner whatsoever as recommendations to buy or sell any financial instrument at any time. Archived online at TalkDigitalNetwork.com. This Week in Money is a production of Howe Street Media Incorporated. Executive producer is Tom Allen.